Mortgage rates are now at the highest level of the year and could still climb. Thank you for joining us. See you next week. I don't like this, guys. I mean, I know what's happening. I watched the 10-year yield because I'm a big dork and I'm a nerd, but like mortgage rates, ever since that inflation report came out, just tick, 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 tick.
So I'm gonna try to give it a positive spin on this. I know rates are bad.
Go for it.
But this last week, I have been speaking to a lot more buyers that have been interested, first-time buyers. And one of the things that I found very interesting is that the conversation changed from why are rates so high to, hey, how can I get into the house and what can we do? So the conversation is like, hey, I'm aware that rates are high, but I don't see anything changing. I quoted a lady yesterday a rate, and then she said, hey, I showed it to one of my friends. She's like, no, it's way too high. Oh my God, why are you going to buy right now? And she told me that she told the lady, look, I understand that you bought 2 years ago when rates were 2.5%. Unfortunately, that's not my decision. I have to make a choice based on what's happening today. This lady's obviously, she's going to sell her house. She has money to come in out of pocket, but she's like, hey, I understand what's happening. I don't see things going down. Houses haven't crashed. If anything, they're more expensive. Like, I have to go take my cuts now and see what it looks like to really know if I'm going to make the move or not. And that's more or less the demeanor that I've been getting from a lot of buyers that I've been speaking to. I'm like, hey, I'm going to just try it out. Like, things aren't looking like they're going to work out or come down. So I got to see what it looks like for me in reality right now.
Yeah. I mean, that's one client, right? Then you have a lot of other clients that are currently approved and they're just going to pump their brakes right now because now their affordability is not there.
Yeah.
Another increase in 0.25%, that could mean another $80 to $180 a month, depending on what that loan amount is.
Oh yeah, 100%.
So I know I have a couple of clients that I just can't do it right now. That $180, that $150 is detrimental to my monthly, and I'm just going to put a pause right now to see what happens.
It's already the limit, right?
Yeah. The bad thing about it is kind of like, here we go again. We saw this back in October. It's like crickets, right? When the rates went up, it was like, boom, things just froze. And this is the highest rates we've seen this year, And so we're barely 3 months into the year, and here we are with these high interest rates, and home prices have not gone down.
No, I mean, they came back because January rates went down and October was this high. Everyone, touched the hot stove and like, oh, I don't like the 8%. And then the market kind of gave up a little bit. And everyone was expecting the Fed, who was being data reliant and data dependent, the Fed's going to make all these cuts in 2024. Doesn't look like that's going to be the case anymore as far as many cuts as they were going to.
Exactly.
They were projecting they were going to do. For the borrowers, like you guys are talking about, to me, I summarize it like this. It's really just attitude versus ability.
Yeah, exactly.
I'm unable, I cannot.
Yeah.
Or I'm able and I want to.
Yeah.
And I know it's not every scenario is that easy to just to like make that just a common denominator, but I think that's just what I'm saying I'm hearing the most of is there's the mathematically ability or inability, and then the desire, I do or I don't. And you're right. I mean, great point that your client made. Like, I can't go back in a time machine 2 years ago and get a 30-year fix at 3.5 on a conventional loan with 10% down, 20% down, whatever. I'm not going to get a VA at 2.25 from 2021. It's not there anymore.
Yeah.
So, and the article kind of points this out too, because they're saying anyone waiting for rates to drop significantly may be waiting for a while.
Yeah.
And Brian and I talked about this, or missing out altogether. So there's kind of like a FOMO mixed into this, number one.
Yeah.
With the attitude.
Yeah.
They may be waiting a lot longer than they thought because you still have shortage of inventory, even though inventory has made a little bit of a comeback. That has not actually generated enough closed sales as we're going to see in a minute.
What happens is I feel like as soon as inventory comes, people flood, and then we go right back to where we're at. So there's not enough time for the market to assess like, the inventory and it's a cool down because everybody just jumps on it right away.
But remember, last week's show, we were talking about how there's homes that are just changing hands investor to investor.
Yeah.
And 20% of the homes from December to December last year, year over year, was from investor to investor.
Correct.
So that means 1 of every 5 homes isn't even offered to your client or your client. So 80% of the available inventory, if you will, is this resale or new buyer or buyer new build, because there's a percentage already baked in that's just going to go to the next investor, and you're not even going to get a crack at it.
I mean, the good thing, guys, the difference between today and last year, we have $120,000. There you go. 120,000 homes more available now than we did last year. That's about a 30%, increase if you did that math there, Andy, and you're good at that. But that's a good thing. The only bad thing about that right now is, and this is nationwide. This is not just here. We're talking about nationwide numbers. I believe there's a little over 526,000 homes now available, which we've been fighting in that 400, 500 range. Yeah. So that's a good thing. Most sellers are now considering like, they're like, okay, this is the new norm. This interest rate. So now I don't think I'm going to go back to those lower rates, et cetera. I'm just going to put my house on the market. You know, it is what it is.
Because now you're swapping one thing for the other, right?
That's
so
correct.
We talk about rates, and we talk about home prices, and what that means to a seller is, well, if there was no collapse of price, well, that means now my equity gain is still there.
Correct.
And over the course of every month I'm making my payment, my balance is going lower, my equity has stayed the same, had a dip, came back up.
Yeah.
So maybe what is best for them is, well, the rate isn't favorable for me to list and then go buy a house for myself at the new rate, but I may have the same or more equity. So now I have, well, the rate's higher, but now I have more money.
Correct.
So there might be money to play with for a buy
And
down.
they also see they also understand being a homeowner is way different from a first-time home buyer coming into the market. They already understand the sequence, the seasons that come with owning a home, right? With the interest rates and all that. So they already see that this is temporary. In a couple, hey, we thought this year where it's going to be 8. Remember last year everybody was saying, there's going to be 8 rate cuts. Well, we have 8 meetings. Like, what the heck? No. Okay, so 8 rate cuts. Okay, good. And then we predicted that you guys were, if I recall correctly, it was like around May-ish, what have you.
I said they're going to be 3 to 4, and they're going to start in April. And that's not going to happen.
Oh, yeah.
And now...
No chance.
And now they might not even be, right? Because what's one of the most important indicators to this, for the Fed to, is one, it's going to be inflation. And the other one that's really important is the job market. They still haven't hit that, guys. Like,
I know. I know.
Jerome Powell is just a lot like. Does he know what he needs to be doing right now?
They're honestly really stuck because the second you start telling people we're going to be data dependent on our decision, which means, okay, now the data is going to drive the outcome. And that's fine if you were already confident that it's going to go in a certain direction. But now I think what's happening is their confidence is getting undermined by the data itself.
Correct.
I think they're not able to accurately predict when inflation is going to come down, and they're just kind of beating around the bush. But on Friday, if you're watching this right now, core PCE comes out, and that's going to be a huge determining factor of where the rates are going to be heading in the next weeks to come. So definitely pay attention to that. And I feel this week has just been volatile, and it's going to continue to be so until we have some certainty. And the Fed haven't been able to give us that certainty. Therefore, that's why we're running around in circles trying to figure it out.
Because they don't even know. They don't. Brian, they're confused. First, they were like, okay, we're going to we're going to slash our rates. And now it's like they're confused again.
Yeah, I mean, I cannot argue that this is what they were hoping for. I just can't. I don't think this is what they were hoping for. Mortgage rates trending alongside the 10-year yield and people's reaction to inflation and jobs. And we talked about this last week. The softening in the jobs market did not happen at the rate and the frequency at which they expected it to. Because even though it might look on the surface like, oh, inflation's killing everybody. Well, it is, depending on what you're talking about. But it's not, depending on what you're talking about. Because in some parts of my life, inflation's killing me. In others, it isn't. But I think what's happening for people who maybe are cash strapped or don't have, like, let's say, income that can keep up with inflation or savings, they're using their credit cards, right? Because we see the credit card balance go over $1 trillion and stay over $1 trillion and keep going. So people are still paying for things. But then what that dovetails into is, oh, well, if it looks like they're still paying the price, then the people, the retailers don't have to drop the price. And if there's no flood of inventory, you don't have to fire sale anything. So in the same regard we talk about with homes on the consumer side, well, if there are no drop of prices, and people are still paying it, whether it's a credit card, cash, or whatever, well, then it looks like they can still pay it.
That's correct.
And so then now it's not transitory, it's baked in. And that's just going to be the new reality.
It's the new norm. Like, like I said a couple weeks ago, Applebee's ain't gonna relaminate their menus, bro. This is the new norm. This is it. You're gonna pay $10 for that hamburger. It's not gonna get relaminated.
No joke. In February, there's a little place that Jen likes to go to down in Bonita. It's a little Mexican taco. It's a hole in the wall taco shop, right? And we went, and like it still had most of the pricing on the board, and a couple of them had like the white paper.
I've seen that
marker over it. Okay, so we went 2 weeks ago, and all of the pricing is covered.
Whoa!
And none of it is rewritten over. So their actual menu has no pricing.
Wow!
So it's basically telegraphing. You just order whatever, and the number's gonna show up on the thing. And that's what you're gonna pay. You're gonna pay
the new norm.
Yeah,
we're tired of changing menus.
I've seen that at restaurants.
Well, so their cost is obviously changing. Their cost of employment is changing. Their cost of getting their raw goods is changing, and the cost of offering the service of the food. But I'm talking from February to now to April.
I'm telling you guys, it was and I share this again. Tanya and I went to go eat 2 tortas, We love this place. And then I got a freaking drink. It was $32.
Yeah.
Like, what the hell for 2 tortas? And I'm going to go to TJ.
Yeah.
You know what? It's even expensive over there. Their peso is
too.
actually performing quite well right now. So I don't know. But yeah, in this article, it does say recent economic data shows that the economy and job market remain strong, which is likely to keep mortgage rates at these elevated levels for the near future.
Yep.
So they already, you know, all these economists and people that understand the market, they're already telling us. They already had that crystal ball.
Remember a couple years ago, guys, I was like, hey, the Fed's word of the year is going to be transitory and the soft landing. This year's Fed motto is higher for longer.
Yeah.
Higher for longer, brought to you by the Fed.